Welcome to Fidelity Sound Bites, a monthly podcast where investors can tap into Fidelity's more than 400 investment experts who are on the ground around the world so that you have the inside edge when it comes to making more informed investment decisions. From equities to fixed income to private assets, let us help you build a better financial future.
Hello, my name's Paul Taylor and I'm Head of Investments for Fidelity Australia. And welcome to Fidelity's podcast Sound Bites, the Outlook episode. With me today are James Abela, who's the Portfolio Manager of Future Leaders and Global Future Leaders, and Zara Lyons, who's the Portfolio Manager for Fidelity Australian High Conviction Fund. And I'm also the Portfolio Manager for the Core Australian Equities Fund. Welcome.
Thank you.
Thanks, Paul.
Okay, so look, maybe a good place to start is just a little bit of a look back on 25, and then I might give a quick overview on that, and then I'll get you guys to talk about how you see 26. So 25 I thought was really interesting. It was a bit of a tale of two halves. The first half being the sort of ructions from DeepSeek and actually the tech sector in China really taking off. Then came
Liberation Day,
thank you, where we had all the tariffs, the trade wars. That caused the market to have a sort of few bumps around that as well. And then the second half, what we saw was a bit of a rotation, actually, which was really interesting, towards maybe probably the cheapest sector in materials and resources. And they performed very strongly. And then also rotation towards small caps as well, which was, I think, really interesting. So there's some great numbers around that. From a macro perspective, Australia had 3 rate cuts, 25 basis points each, so 75 basis points in total. Now, while that was positive, and it did help sectors like the consumer discretionary sector, probably was a little bit less than what people were looking for. And then even as we got to the last one, there's probably a bit more of a hawkish tone. So maybe, we shouldn't expect many more rate cuts, and some people are even suggesting a rate rise again, which would definitely be very interesting. The Fed did something very similar, so 3 rate cuts in 25 as well. So rotation into materials, which was primarily things like gold, lithium, copper, and even iron ore didn't do too bad either. But let's leave the look back there and let's talk about 2026 and how everybody sees it. But I might just start off with a sort of a bigger picture question as we look forward first. And Zara, last decade's been defined by a shift to passive investing supported by broad market tailwinds. How do you feel being an active investor in markets today?
Thanks, Paul. That's a big question. And, I'm really excited about active investing. I think the future will be impacted by a higher neutral rate. I think that central banks globally are grappling with more sticky inflation and what that means for central bank cash rates and how that will play out across, global industry, supply chains and so on. So I think it's really interesting in the sense that what we've seen and what our global macro team's quantitative analysis shows us that over the last 15 years, that active managers have tended to outperform passive managers during periods where markets don't have strong returns. And I suspect with a neutral rate setting that the outlook is for more muted returns than what we have potentially seen in the past 15 years. Also, active managers tend to outperform when concentration in markets broadens. And so what we've seen over the last few years has been a real narrowing of stock performance, particularly in tech. You've seen that particularly in the US, but globally there has been sort of certain sectors that have really outperformed. And even locally, over the last 12 months, we saw very strong performance in the ASX 300, particularly in the gold sector and defence sectors, and that was very much skewed to the small cap names.
I was going to say, James, does that all of that resonate with you in the mid and small caps?
Yeah, look, what happens is there's huge themes that come into the marketplace. So now it has been your gold and defence and also tech. And passive does pretty well. The index is doing very well, and passive also tends to do very well. But when markets do come down, that's when active really comes into its fore, and the breadth of performance and the as the correlations start to fall, that's when active management really comes into the market.
Right.
And you definitely this year, small caps was up, nearly 20% this year. My index up 17, which is a blend of mids and smalls. But smalls is up more than 20. And that's 2 years of plus 15% compound returns for 2 years in a row. So it's been a very strong market. So I do think also that this next year will be a bit tougher. It's not going to be as easy to get, huge returns this year. The market's not looking particularly expensive. The market's only on 20 times. And it is growing double digit. But you got to remember, looking back, resources were up nearly 70%, 70 this year. That's a massive number. And it's the biggest percentage of the index that it's been for a long time. It's nearly 25% of the index, which is huge. It's normally in the 10s to 12s. So it's effectively doubled in terms of scope and size. But the negative for small caps is that the ROE, the return on equity of the index is actually quite low. It's around 7 to 8% right now.
Right.
Now, normal's about 10. So for a PE to be at 20 when the ROE is at 7s and 8s is an unusual environment, but it's because of the weight of resources. It's because loss-making stocks have come into the index. The domination of lower return businesses doing well, because the momentum means that it's going to be likely a tougher year next year in 26. So there'll be, like Zara mentioned, higher dispersion, I think, low correlations, big themes. It's got to probably broaden out. So it's going to be an interesting one.
So what I'd love to do is delve into the resource sector, because that was probably the turnaround in the second half anyway. What's your outlook? Is that we're going to see more of that in 2026? How do you view the materials or resources sector?
Well, I think the materials sector should be well supported by enthusiasm for copper and lithium plays. We have seen strong momentum in those names leading into the end of 2025, but I suspect that will continue to persist into at least the first half of 2026, and that's driven by electrification themes, EV demand, and also data centre demand. Would you agree with that?
Yeah, for sure. I think, look, this year has been huge in gold, copper, lithium, but also tools and services. So anything that related to CapEx. And then you link that into the AI theme, which is why the commodity prices are lifting and all of the other end user market changes that you mentioned. I mean, AI is a massive theme. It's, we're supposed to be a $300 billion spend this year. We're now looking at maybe $500 billion next year. It's just absolutely enormous. And that's leading to a lot of commodity price pressure, and commodity prices have been very strong for it. The gold thematic market, the world's still worried about markets. The world's still worried about store of value. So gold's, at all-time highs. So I don't see that changing. I do think resources should be quite strong during the year. AI capex will continue. The concern over markets will continue. Risk spreads, etc. The cost of risk means gold will continue to work. So I do think resources, are likely to do well during 2026, and it's hard to see why they won't, because all the fundamentals, as well as end markets, as well as activity levels, all of those three things are all pointing to support.
Thanks, guys. Okay, James, the other big rotation in the second half, or probably from about April, was a move into small and mid caps.
Yes.
Once again, is that a rotation you think can continue in 26?
I do think it can. Like I said, I think the returns is the only risk factor and the only thing that you can see is a bit of a red flag. But apart from that, earnings are going upwards. Markets are up over 20%. The very good thing about small caps is that it's not just one sector. Its resources are up, more than 50, 60%. But tech's done well, consumers done well, financials have done well, and industrials have done well. So there's quite a spread of sectors that have done well. And that's really why the confidence for the support for that universe to do fairly well during 2026 does remain.
Yeah.
But the only red flag, as I mentioned, is loss-making stocks you've got to be careful of, and also very high PE stocks and their momentum thematics you've got to be really careful of. And we've already started to see a couple of warning signs coming to us in the marketplace. So Drone Shield was at $2, it went to $6 and then came back to below $2. Temple & Webster has been a very strong high PE growth stock. That came out with a disappointing result. And that was off 30%, in the last couple of weeks. And then you've had Bendigo Bank was part of the large cap bank thematic that everything's fine, everything's going well. And that stock's down, 20% for the month. So you got to be careful, I think, extrapolating the confidence, extrapolating the benefit of low interest rates, extrapolating the benefit of commodity prices, extrapolating the benefit of kind of a very comfortable, loose attitude towards risk. And that is, I think, what you need to be careful of going into 2026. And like I mentioned, you've had a couple of warning signs already in the last month. And I think that's what you need to be aware of, especially as you go into reporting season in 26.
The other thing I always think about, I'd be very interested in your views on this, is to me, small caps are typically a little bit more domestically focused. So it's the local economy. So I was also thinking with Liberation Day, or maybe there's some more fears on global activity with a re-examination of the domestic economy. Do you think that's reasonable? Or
It has benefited. I mean, a lot of the surge has been mainly domestically focused, so it is resources, but it's linked to global end-user markets, I guess. Mm-hmm. But a lot of them have been more domestically focused across, technology, industrials, consumer. But I'd say with the resources piece, it's much more global, linked to commodity prices than global end markets. Okay. So it's a bit of a blend. But I do think if the US is softer, it will affect resources probably more than probably all the other sectors. Yeah. And that's probably the conclusion to take out.
So valuations is one we also should touch on. And Zara, a lot of the blue chip stocks, some of the valuations are up there. How do you view 26 from a valuation perspective?
Look, I think valuations in the sort of the big cap space, I feel sort of peaked back in June and subsequently. And the reason for that was the difference from Liberation Day to June, we saw a rally to safety, a flight to safety. So you saw a lot of these defensive names work because of fears of investing in the US, and you saw flow of funds coming into Australia. But subsequently, as fears have receded, particularly when Trump became more collaborative with China around the 10th of October, you definitely saw a sell-off in basically a reversion of that trend. And you've actually seen those names become a lot more attractively priced. So I think the valuations are there to warrant, and the earnings are there to warrant, and the balance sheets are strong. So all of those things sort of warrant the current valuations. I don't think we're particularly stretched in terms of the big caps. So I'm excited about the opportunity set there. And in fact, when you look at the ASX 300 performance, I know James has been citing the small cap performance of nearly 20%. The ASX 300 is only up about 3.8% over the year. And it was quite dispersed in terms of sectors. And two sectors that really stand out as having underperformed is healthcare, which was down 22%, and tech, which is down 16%. So there are some opportunities there to look for alpha going forward in 2026. Materials have obviously had a strong run, but I think there'll probably be more support for materials next year. And financials delivered 2.8% over the year, but it was a wild ride through the year. CBA hit $191 and is now down to back to 150 odd. So, you've seen quite a dispersion of opportunities to harvest alpha through the year and through all the different sectors. And I think we'll expect more of the same next year. You just have to really be working extra hard on execution. You can't sort of set and forget in these market conditions.
Yeah, that's a good lesson.
What about
James?
The reflection of Woolies, CSL and Hardy's, three big blue chips that fell this year, the fallen angels? What do you think the lessons are, and are there more of those coming in 26?
Oh gosh, I hope I don't enjoy fallen angels.
A lot of them had earnings issues, right? So
it's been a challenge across.
Hardy's had, I guess, acquisition risk,
yes, it was
corporate governance as well.
So all of them sort of had multiples from either governance, management credibility, earnings misses.
And acquisitions. I think the biggest thing for me learning has been around monitoring companies that make acquisitions that ostensibly look good on paper, but in reality are plugging a hole of an earnings nature somewhere. And generally the market, the companies have been overpaying for these assets or paying very rich multiples for those assets, and then they have challenges around integrating the assets potentially. And or the market now is so fast to just discount it into the price first, and we'll wait for evidence that you can actually deliver that integrated earnings uplift that you've promised in the investment banker's pitch book. So I think that's something that we have a lesson learned.
Look out for it.
Yeah, absolutely. So one stock that I think is really interesting is WiseTech. It's obviously had a very wild ride. It had a peak of $133 this year and sitting around, has hit lows of $60. And it fits that $1 billion narrative in terms of acquisitions. It bought E2 Open, which has in the market has been criticised as an acquisition, but it's also facing the AI trend issue and or risks around that. And I suspect some of the fears about AI either adversely impacting the business mix or impacting the actual marketplace overdone. And you've also got the opportunity for the company to deploy its new commercial model, which is essentially being able to price more effectively for the utilisation of AI inside the business and also being able to harvest gains from AI inside the business. So I think it's a really interesting one where the messaging from the company has been a bit conflated because there are so many different things happening, but the proof will be in the eating through 2026 if they can deliver cost out, if they can deliver earnings growth, if they can deliver acquisition-led earnings uplift as well, and hopefully turn that multiple D-rating back to a re-rating.
Actually, that's probably a good segue into the next topic, because I guess AI has been a dominant theme in markets for a while, and there definitely seems to be two camps: people that are big believers in AI, that it will change the world and bring a lot of productivity and cost efficiency to companies. I think it was really interesting. Our global tech team basically looked at the S&P 500 in the US and found that 1/3 of all capex across the whole market was
AI
basically
related.
it was going into AI, which is an incredible amount of money. And then there was some questions about, well, are we going to be able to earn the return on that investment? And that's probably still a there's a question mark. Yeah, it's a debate. But it does show this, the importance and significance that companies are putting on AI. And I think, to me, the interesting thing is obviously when there's so much spend in AI, and that's benefiting the companies that sell the AI. And I think in markets that's probably what's happened. But as we've been catching up with companies, I definitely feel like the next phase is going to be what costs can be taken out from companies, because it could actually be very, very significant. We've done a few site visits to different automated distribution centers, and it's very impressive how they're integrating AI. Do you see that continuing through 26? Do you see big opportunities for companies outside of the ones that are selling AI?
Yeah, well, I'm sure you've got comments on data centers,
Yes.
James, so I'll leave you with the data center comments. But, I mean, AI, it's a huge continuum from data centers, from the technology and the hardware that's deployed into those centers along the chain to software. And the Australian stocks the tech stocks that we kind of look at are generally software names. They're not typically hardware names. So the concerns around AI for them is that there's a displacement fear, that there's basically three main issues. There's what they call vibe coding, which is essentially the threat of using AI to imitate the vibe of an existing software by using AI to create it. So you tell AI, I want the vibe of the WiseTech software, please. And it can generate that. And so that is a genuine fear, and particularly for travel aggregators, for example. There's the threat around seat compression, so the threat that AI actually replaces the number of employees in a business that's using the software. And so with that, the threat is that if the software model, the revenue model, is based off charging an amount per seat, then the tech company needs to change the revenue model, which is something that WiseTech's been doing.
Yep.
And thirdly, you've sort of got that AI native competition. So the threat of genuinely innovative disruption. And really, it's about the fear here is really, are the incumbents match fit ready to lean into the challenge around that and be able to take advantage of their incumbency? And I think the market misses the fact that incumbency advantage is a real advantage that the tech companies can utilise, and that enterprises tend to move slowly when adopting technology. Right. Things don't change overnight, but obviously market multiples derate very quickly. About concerns are on this. And lastly, there's a lack of model supremacy. We don't really have one AI model as such. There's multiple engines both in China and the US, that can be used. So there's no sort of one single winner-takes-all type situation happening. So, I think there's some opportunities for these software names to actually lean into the challenge of AI, and that it could actually yield more benefits for the software players that are listed on the ASX.
James, yeah.
Oh, look, I think it's the next industrial revolution, ultimately.
Yep.
This is the next industrial revolution that's going to change everything that we all do. So it's a massive productivity tool. So that's point one. Point two, the breadth of it, I think, is just now being understood. It involves data centers, it involves cloud, it involves software apps, it involves hardware, it involves productivity tools. It will displace things for sure. It will do things faster. It'll do things better. And the breadth of it started to begin, I guess, in the last 2 years with tech in consumer, tech in medical, and tech in financials as well. So fintech, medtech, consumer tech. And now that's becoming, basically broader and wider right across the spectrum, as I mentioned. So I think it will be very significant. To invest in it locally, there's a limited number of names that you can get exposed to through data centers and things like Life 360 through software. Globally, the opportunity set is very significant. So you can invest in all those areas: data centers, hardware, software, semiconductors, cloud, all the enablers and facilitators that are available. So I do think it is very, very significant. What is happening for investors in the market is interesting. The market's basically been divided, especially in the US, into 3 categories. So AI winners, and all of those groups that I just mentioned are AI winners. Then there's AI losers, so things like classifieds and call centers. We've had stocks, Concentrics, for example, is a stock that's gone from 25 times to a PE of 3.
Oh, wow.
In 15 months. It's just wow.
Yeah.
Right, and classifieds on 50 times, like an REA and car sales of Europe, going to PEs of 15. So you've had these PED rates which have been absolutely enormous and mind-blowing. And so that's the AI loser category. So you've got to be careful if you own stocks that are in that category. And then you've got the third thing, which is really productivity tools, and where, like you've mentioned a few, that productivity tools of AI will lead to displacement, but it will lead to productivity. So the positive element of it. So I'd say there's quite a few things to think about as investors, but I think the number one thing you need to think about is make sure the companies you're invested in are not AI losers.
Yeah.
Because the derating on those has been absolutely enormous. It's unlikely to change in 2026. And the AI winners are more likely to compound and continue to evolve in that revolution that's taking place. So that's what I'd say in terms of AI.
So it definitely sounds like AI, the whole thematic and focus is still going to be playing a big part.
It's
in
huge. And like you mentioned, it's
forward,
nearly $500 billion US dollars of CapEx. It's just massive.
Yeah.
And it was, it was predicted to be around 300 and something this year.
Yeah.
So it's even going faster. And I know for companies we invest in, much like the resources boom in Australia that we experienced in the last decade, it's creating an urgency amongst those spending the CapEx. So it's creating inflation in sparkies, electricians and plumbers, because all of it has liquid cooling. So there's plumbers and sparkies that are basically having to build and engineer. So those 3 categories of engineers, sparkies and plumbers, the pressure on that, people are moving off construction sites, people are moving off mining sites and moving into the AI space because they can get paid better.
Yeah.
And so the inflation.
And live in the city.
Yeah. So it's just, it's amazing how it's having all these derivative impact.
Yeah. Awesome. Okay. Thank you. Now, just before we go into bold predictions for 2026, I thought maybe we just round out on markets because I think, Zara, you touched on it, that the sort of broad-based market is probably about with the market, the year's not finished yet, so things could change, but, about 4% capital return, about 4% yield. So we've got a total return in the broad-based market of around 8. James, you also touched on the mid and smalls, which was a better result, so probably high teens for the mid and smalls. Looking at that and looking at 2026, do you think that's about right? I know it's always a bit hard to do it in the short term, but they're the sort of numbers, or is it, is it all about earnings growth in 2026? And
I think, look, for Australian mids and smalls, I think double digit is likely.
Yeah.
Doing more than that's going to be tricky because then we've got 3 years of 15 to 20% returns, which is actually tough. Like I mentioned, the ROE factor is return on equity is a factor that signals there's a bit of risk, but it's likely to be volatile, and it's also more likely to be led by quality and momentum. This year was definitely a momentum year. It was all about earnings.
Yeah.
And I do think 2026 is more likely to be a blend of quality and as well as earnings momentum.
Yeah.
And that's what I think is something you need to keep in mind for 26, because chasing momentum and themes this year has been the easy money.
Right.
But 26 is more likely to be much more blended.
Yeah, that's much more bigger focus on execution.
Execution, like Zara's touched on that, and then you've touched on valuations and sort of the themes of 25, and I think they will be a little bit different in 26.
Yeah, for the larger caps, I think it's probably a steady as she goes type approach. I've always talked about the Australian market being a workhorse, not a racehorse. So it generally does pretty good returns each year. It's never the market's unlikely to double, but it's also much more stable than most other markets around the world. So getting that sort of 10 to 15% return on invested capital, Australia does that pretty consistently, which is very good for the companies, and generally has that nice mix of capital return and yield. So I mean, I would look at the market being in that same, somewhere in the high single digit type range. I think is very reasonable for expectations for the broad based Aussie equities market as well.
You're right, double digits, so about 10% for the ASX 300 is forecast. And over the 3 years, it's about 8.6%. So there is an expectation by consensus earnings that we'll have a strong
growing.
outlook, growing earnings.
It should be a reasonable year.
And it looks fairly broadly dispersed, actually, which is also really encouraging.
That is
across the
positive, yeah. I
sectors.
think there's a market broadens. I think that is positive for equity markets. Let's get into the interesting stuff then as well. If I look at some of our bold predictions from last year, unfortunately, I predicted the Wallabies would win all 3 tests against the Lions. They only won 1, but they should have won 2. The IPO market to reopen, I think we saw a few IPOs, but I wouldn't say it's a big move into IPOs, but we actually did see a reasonable number. We had Virgin was obviously the biggest one. So we had a few, and it probably did reopen, but a lot more activity. More M&A activity led out of the US. I think we did see
A lot of takeovers.
We did see a lot of takeovers, and I think we'll probably see more of that in 26 as well. The big one for us, we had a big position in Domain, which got taken over, which was a great result. Yeah, so I probably see more of that as well. And James, you were very much on the tech sector, which in the mid cap and small cap did do well.
It did do well. Just resources did better this year for sure. So
yeah. So now, what about 26? What are you guys going to back in 26?
Oh, good question. And I'm not actually sure if my tip is actually going to, be able to be checked.
Oh,
but
that's it. That's the best sort of tip.
Yeah. But I'm interested in GLP-1s, and I noticed that they're being genericized in China, Brazil, and India.
Yep.
So that'll drive lower cost
Yep.
GLP-1 drugs. So I'm curious about how that plays out in the global markets and whether or not, you end up seeing proliferation of back channels, websites and so on, being able to access those sorts of products. So that's my prediction, that we see some deflationary impacts from that.
very
Cool.
good.
James.
I'm just going to go with the same. I think tech dominates in 2026 again. I think it's going to be the year when AI comes into the more centralized part of the market, becomes into the Aussie market a bit more, becomes more top of mind in management discussions. So I do think technology is probably the most interesting and certainly has potential to be a very good performing sector in 2026 again.
Yeah. And I'm probably going to do a derivative of that, which is, like I said, AI to me.
Can't all say tech.
Well, it's not. Well, it's AI. It's AI related, right? But to me, it's actually not. I actually think we'll see a transition from the sellers of AI, because the actual implementation of AI is very cheap to actually get for people to actually use it and implement it. It's very low cost.
Yeah.
So I actually think 26 could be a year where we start to see some of the real cost benefits, the productivity, cost efficiencies come through in the supermarkets, in the banks, across a lot of companies. So actually, I think that we could see AI being a dominant theme, but actually in, the everyday companies, across the market. So I think that could be interesting in 26. Excellent. Well, guys, thank you for that. I thought that was a great discussion, both on 25 and some views on 26, and hopefully people get some good ideas out of that. I would just like to take the opportunity to thank everybody for joining us, not just this episode, but right through the year. I would like to also wish everybody a very Merry Christmas and a Happy New Year. And I hope 2026 is a great year for investing. Thank you all.
If you've enjoyed today's episode, make sure to subscribe to Sound Bites on your favourite podcasting platform. Otherwise, if you'd like more information on Fidelity or Fidelity products, please head to our website at fidelity.com.au. Now for some important information. This podcast is issued by Fill Responsible Entity Australia Limited, AFSL number 409340. This podcast is intended as general information only and has been prepared without taking into account any person's objectives, financial situation, or needs. You should consider the product disclosure statement and target market determinations for Fidelity Australia products at fidelity.com.au. Please click the link in the show's description to read the full disclaimer.